What's up everyone, it's Scotty with Money Vesting. So in this video we are going to be talking about Tom Lee's explanation on the price to earnings multiple, and also talk a little bit about the breadth behind the markets as well, and how strong of course the S&P 500 has been, and what to expect moving forward, especially 12 months out when you do have a certain number of stocks trading back over their 50-day moving averages. So hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, link to our Discord and Patreon is going to be down below. If you're interested in joining us, there is a 16% annual discount that does expire at the end of this month. So literally today is the last day if you want to take advantage of that. And after tonight, so after midnight, both the discount for the Discord, which is 16% annual, and the 50% coupon code launch for the options course, both of these will expire and go away for good for a long time. So again, if you want to take advantage of it, link's going to be down below, and we'd love to have you on board. So this right here was the actual thread from Tom Lee, where he is explaining the price to earnings multiple. It is a little bit more abstract, so again, it's very subjective, which I do agree with for the most part, but there are going to be some pushback here, so we'll take a look at that as well. So he says, and I quote, "Many say that markets are expensive because PE is 20 times. One may not realize this is ascribing anchoring power to an abstract concept." So again, valuations are very subjective, and that's what he's really referring to here. So 20 hours ago, he said PE is ratio between the price, which is the P, and earnings, which is the E, right? So price to earnings is P over E, and each of these has an entire field devoted to each, right? So technical analysis, the study of price; fundamental analysis, the study of E, which is earnings, and that so far so good, right? Price is really the stock price, the S&P 500 price, the index price, it's moving up and down, and earnings are the actual earnings, which is the denominator, which is obviously requires a lot of fundamental and macroeconomics as well. He further goes on by saying, the understanding the above, this is why price to earnings is way more abstract than many realize. Which E to actually use today, 2024, 5 years out? That's the question that he's asking. And then he says, which E does market care about? Last year, next year? See what I mean? Is what he's talking about. So what he's really saying is that we don't know what earnings to actually use, okay? What earnings actually makes sense. Now, this is where I do have a little bit of pushback, because when it comes to price to earnings, when it comes to earnings specifically, right? As investors, our goal is to really be focused on, say, the next 12 months. So when it comes to the price to earnings multiple, obviously E is going to be the earnings. Now, I do have a little bit of pushback in this for Tom Lee, because when it comes to investing, right, when we are investing in the markets, we're not really focused on the last year. We're not really focused on what happened historically, or like, we understand that the averages do matter, historical averages, but we're not really forecasting for the past, right? We're really forecasting for the future, and it's really forecasting for the next 1 year, at most maybe 2 years, because at the end of the day, it's really just a comparison of the next year's earnings relative to the price, relative to what we can get as the next best alternative, right? And when it comes to investing, everything is an opportunity cost, right? You're investing in one asset and you're giving up the opportunity to invest in another asset. So the price earnings multiple, yes, it can be subjective. Yes, it can be abstract. We can have an argument over, whether 19 or 20 or 16s, what is an appropriate level. But for the most part, we are really focusing on earnings for the next 12 months, right? So forward looking, we're forecasting, and we're also looking at it over the next 12 months, because that's going to give us a little bit of a understanding of earnings yield, which we can then compare to the bond market or other investment opportunities for the next 1 year, and figure out, okay, whether it makes sense for us to be investing in the markets or not, right? Whether there's better opportunities out there, because like I said, at the end of the day, everything's an opportunity cost in the market. So furthermore, he goes on by saying, moreover, here's a fact. So one says S&P 500 expensive at 19 and should be at 16. How many times in 75-year history did the S&P 500 trade exactly at 16? Answer, 1% of the days, maybe less. And for SPY, keep in mind, this is comprised of 500 companies. Should each of those 500 stocks be trading at 16 times earnings multiple? Which E? Nobody agrees. And has this ever happened? Nope. So those are some actually good points. The first one, definitely a very, very solid point. I mean, you can't find the S&P 500 trading at that cheap valuation very often. And that's what makes it a rare occurrence, right? So if you go back to our videos from back in October, I specifically mentioned, and actually there was a chart that I talked about. There's a market timing game online which basically shows you the percentage of times the S&P 500 is down over 20% from its all-time highs. And that number is, I think, less than 10%. I have to go back and double check, but that number is less than 10%, which is just crazy to think about, right? I mean, if you think about it, in the last 100 years, 150 years of trading in the market, the S&P 500 down over 20% from its all-time highs has happened less than 10%, might even be lower. Just think about how rare that really is. So if you come across an environment in the future, let's say in your investing journey, your trading journey, like 5 years from now, 7 years from now, you come across an environment where the market's down over 20%, it's in a bear market, you got to take advantage of it, right? I mean, it's going to be a rare occurrence, and that's exactly what we saw last year. And we also obviously talked about it in plenty of our videos. So I do agree with him there that yes, it is very rare for the S&P to be trading at 16 times earnings multiple, even though the historical average is closer to 17, 18 times. Now this right here is the final thing. So Benjamin Graham is the father of value investing. His formula for PE, 18 and 8.5 times is the base, plus 2 times expected EPS growth. So SPY EPS 79% with buybacks. So you multiply that by 2. So we're looking at 14 to 18, and you add that to the 8.5, which is the base, 22.5, 26.5. I'm actually not sure if Benjamin Graham actually did that. I might have to double check because this does seem a little bit odd for value investing to be 22.5 and 26.5. But I definitely would have to confirm this. If you have more knowledge on this, definitely let us know. But yeah, 22.5, 26.5 definitely doesn't seem like a value type multiple, so to speak. So, but this right here is another really important metric that I wanted to go over. So percentage of stocks that are now trading above their 50-day moving average for the S&P's crossed over 80%. So that again is a very substantial number. And just a few months ago, we were sub 60, right? So we've seen a lot of stocks kind of trade back over their 50-day moving averages, 200-day moving averages. In fact, if you take a look at their 200-day moving average, we're pushed up to over 70% now. So we're definitely seeing a lot of momentum. We've definitely seen a lot of broad-based rallies in the market. And this right here is a good chart going over a rare bullish breadth signal, which is over 90% of stocks in the S&P 500 closing above their 50-day moving average, and what the returns might look like 12 months from now. And 12 out of the 13 times the markets are higher 1 year later if over 90% of the S&P 500 is over their 50-day moving average. That's a very, very broad-based momentum coming in from the market. And again, you can see 12 months, we've seen nothing but greenery with a median gain of 14.4%, average gain of 17%, and a 92% probability the markets are higher. So I think it's just a waiting game, and for us to see that continuation in the rally, and of course a lot of stocks continue to make higher highs, higher lows, trade above their moving averages, doing a very good job in kind of pushing higher to their 52-week highs. So if this continues 1 year later, the chances, the probability, the odds for more upside are definitely in the favor of the bulls, and of course over a 92% probability for us to see some more upside. But that being said, again, there is going to be some pushback on valuation. I'm not comfortable paying 20 times earnings multiple. Sure, it's still a little bit better than the 10-year yield and some of the other alternatives, and for those reasons, I'm happy kind of dollar cost average more broadly. But when it comes to individual stocks, obviously there's a lot of them trading at 30, 40, 50, 60 times earnings multiple. So this is a market which is getting a little bit more frothy. It is not there yet. It is definitely on its way there, but it's by no means cheap, right? It's by no means a level where you could be like, going crazy over these prices, or I would be like drooling over these prices. Those days were obviously back in October, November, and those days are long gone. And now we've seen the markets do nothing but go higher and higher. So I hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Let me know in the comment section down below. What do you think about this whole idea, this whole debate of the subjective nature of the valuations and the price earnings multiple? But make sure that you drop a like, and of course Discord link up below, and of course down in the comments, 16% annual discount and the 50% discount on the option scores coupon code launch, and both of these expire tonight. So after midnight they will be gone. You can take advantage of it while it's still here. As always, happy investing. I'll see you all in the next video.